FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
We're back. You are listening to the Financial Survival Network. It's Kerry, Lutz, and we're fortunate to have Danielle Park back with us. It's been a little while. Summer vacation schedules get in the way, but Danielle, welcome back.
Thanks, Kerry.
Hey, so interesting things happening here. We've got yields going down, and obviously the Fed is probably not happy about that. Briefly, tell us, what do you see happening around the world here, the stock markets, business cycle? Where are we at?
Well, we're at, as far as, the tapering aspect goes, they're down to 35 billion a month of bond buying, and the Fed is likely to be out of it entirely by October. But this month, they are already not consuming all of the treasuries issued in the U.S. So that's a change from the past, year or so when they were consuming, when the Fed was buying basically every bond by repos from the banks, every treasury that was issued by the government. So now you've got a lower spending deficit currently in America, but the fact is that not all the bonds are now being consumed by the Fed, so some have to go on to the open market. So we're about to get some actual price discovery in a way that we haven't seen now for the past, 18 months for sure, as QE ramped up to the 85 billion a month point. So it'll be interesting to see what happens here. There's many people who believe that when the Fed is not consuming, that rates will naturally go higher. I have not been in that camp. And the reason that I believe that rates indeed may go lower for a period here is this whole idea of relative risk in the world and relative yields and captive capital having to flow somewhere. And you've got this myriad of asset bubbles as you look around the globe again today, which is huge capital danger for anyone that's in the business of trying to preserve actual cash and liquidity. And so that global interest rate chart that I put up, Kerry, not too long ago, just really gives a perspective. The top 11 major developed economies in the world, you see that U.S. 10-year Treasury yields. I mean, this was as at the end of June, but the 10-year was yielding 253 in America at that point, and Canada 223, and that's why North American bonds were actually the highest yielding of the relative value available in the big 11 economies. And if you look at the the economic picture strength or resilience of some of those underlying countries, like certainly France, whose 10-year Treasury yields are 1.69. Japan 0.56. I mean, the mind boggles when you think of the actual risk and the actual deficits and the actual debt levels, which are ballooning in those economies, that they're paying lower global interest rates, to their bond holders than we are in North America. So that's why I think that the whole theme here in the next while, I believe, is this slowing growth, demographics that are very unfavorable, and older people, less spending as we go along. And then the weight of the debt. Again, the weight of the debt has built over the past 5 years, not diminished. There's more debt in the world, which means less consumption ability, which means slower growth for the next at least couple of years, which suggests to me that you're going to have a bunch of capital coming back to look for relative security in places like the U.S. dollar, U.S. T-bills, probably Canadian bonds to some extent, because we're seen as your sort of poor little cousin over here. So it'll be interesting. Well, I guess my point is that this month, for the first time, we're going to start to have some price discovery. And I think the other thing which I think is relevant is, a lot of people have become so complacent with risk assets today in this expectation of the Fed put, and that there can't be much downside so long as the Fed is, very fixated on maintaining liquidity. But the fact is, and history will back this up, that when you have this much this much leverage in the system, this much debt, this much bullish sentiment, margin use, et cetera, you can have these extremely rapid corrective phases too. So I'm not predicting that we necessarily will get that this time, but it's certainly within the realm of the sort of statistical, probabilities of what we've built here on this house of cards the past couple of years.
Yeah. So you really think there's going to be price discovery, huh?
Well, there is being some price discovery. I mean, again, if you left, you can be as critical as you want about, bonds or whatever. But the point is, there is fiat currency floating around the world, trillions and trillions and trillions of dollars of it. And it does have a mandate a lot of the mandate is not just to be a wild speculative, buy whatever's going up, but try and actually match certain things like liabilities with assets, with maturity dates and duration dates, with responsibilities and obligations that are coming up. That's what the bulk of the capital in the world is actually doing. And so when you look at your relative choices, which I have to do every day as an actual manager of assets, I have to look at, my first number one priority is to try and not lose money. And my second priority is to try and find safer yield wherever I can glean it. So that's what I'm saying to you. You're getting a bit more free market force coming into this as the Fed backs out of this gobbling up of every bond that's issued. And that in itself means some kind of discovery process. So in fact, you saw 10-year Treasury yields break below 250 in the last little while, Kerry. And now, so my partner Corey's been doing some chart work on that and suggesting, 229 is sort of the next support level. And we'll see. But if this slowing global growth or, this very aged cyclical bull that we've been in the past 5 years, if it's coming towards the close, you're going to see a slow growth, disappointing period again. And I think you're going to see flight of capital going back to what's perceived to be the safer, more liquid bets.
So this is really a bad sign, these yields going lower for the global economy. It's saying that, hey, prospects are dim, and it's also making a bad statement for the emerging markets as well, right?
Yes. Well, it's again, there's a one hand and the other hand here. On the one hand, lower rates is what a very indebted populace needs to try and make its payments, including governments. On the other hand, the fact that there is, the valuations that are available in risk assets and risk markets today are so extreme that even if you were to buy them and even if you were able to hold on to them and endure great volatility and sort of turned your eye away from the fact that you're exposing yourself to a lot of capital risk in holding those things, even if you were able to, the reality is that over the next decade, you're likely to make zero to negative returns. And that's because we are so overvalued. This is like 2000 sort of range all over again, 1929 or 2000, you pick. And they're sort of the who's who of the worst possible opportunity set. And so capital, thoughtful capital, not the speculative crazy capital in the world of which there's some, but the thoughtful capital goes, you know what? I'd rather park it here in this relative safety than, lock in. In other words, you can reach for risk today, but you're likely to earn less than that same 2.4 or 2.47 on a 10-year Treasury over the next 10 years. Believe it or not.
Really?
Really.
Mm-hmm.
So what that means is that you don't have to necessarily buy a 10-year Treasury and hold it for 10 years. But if you can park there while the repricing inevitably takes place in some of these really insanely priced asset classes, and then buy things, at relative lows again, then you can afford to wait for a few years as things slowly recover. And if there's no big V-shaped recovery the next time, it's not such a big deal because you're going to be receiving some income while you wait.
Yeah. So you think what are the odds that there's going to be a fire sale?
I would say, let me see. How can I quantify the odds of that? I mean, I could talk about many metrics that we follow, like monthly RSIs on many of the sectors, the growth sectors are more than 80 today. So a way of quantifying or articulating that in common speak would be to say that there's an 80% chance that prices will decline and a 20% chance they may appreciate a bit further. I guess that's one way to look at it. In some cases, they're 90 range. Again, This is in the range of just nonsensical, thoughtlessness. But history is a great equalizer in that sense. Is that you really don't get it all your way all the time. So the Bulls have had it their way the past couple of years. Well, the past 18 months in particular. Since the QE3, really goosed in the belief in the Fed put and all that. So they've really had it their way the past 18 months. But the fact is nobody gets it all their way all the time. And so when they're rejoicing about how they've made back their losses the past 5 years, what's coming up next is a retracement or mean reversion where you got to give back what you've been overpaid. And unfortunately, those same people have no exit strategy or have no defensive mechanism. I've watched one after another commentator and journalist succumb back down to the buy and hold is all you need mantra. And we saw that in 2007-8 when they threw out any need for, proactive risk management and decided all you needed was to hold a basket of stocks or an ETF or long always, don't worry. And so they've all talked themselves back into that. And I see that as they're all standing on the ledge along the Empire State Building. And the problem is that once they realize that they're toppling, then they all start to panic at the same time.
Wow. Yeah, well, I knew it was risky and I knew what they were doing was dangerous, but I didn't know it was that bad. And although, obviously, the belief that a trend in motion stays in motion until otherwise. But hey, when we return, more on this, and we'll be talking about Elizabeth Warren and whether or not she is presidential timber on the Financial Survival Network.
FSN Radio. It's all about what's next.
Warning, you might live in a no-constitution zone. It's the shocking story you won't see on TV. Depending upon where you live in the United States, you may no longer have constitutional rights. Politicians are quietly squeezing the middle class to micromanage you and extract your wealth. Want to see how? Watch the free video at noconstitutionzone.com. Soon, you'll have the last laugh by using these cultural contraband tricks and profit like a king. That's noconstitutionzone.com.
The Financial Survival Network. It's all about what's next.
We're back and we're with Danielle Park. And Danielle, so eventually this risk pie, this, this science experiment will eventually blow up in everybody's face. But the public has a short memory for all this, don't they? And eventually they forget and they put their money back in, except when it really blows up. I remember people from the Great Depression, they didn't go back in stocks for 30 and 40 years. Some of them didn't go back for their whole lives, right?
Yeah, I was just writing about some of this in our upcoming client letter. But it took 25 years after 29 for the stock market to recover that peak level. 25 years. Yeah, so
long time.
When you look at that in terms of real returns over that 25-year period, they were, negative. So, because nominally it took that long just to get back to where it was. So, Nassim Taleb wrote that great book, Black Swans, and he also wrote The Black Swan. He also wrote, Anti-Fragile in 2012. And
right.
I think there's a sobering that needs to come in here because everyone is so there's such a propensity for shallow thought today. And this is endeared by the snippets of media, this and that, and, grab a bit of information and run kind of thing. But the ruminative reflection to actually figure out where you're at, like I liken it to coming up in the middle of, the Great North on a dark night with nothing to go by but the stars to look at. If you were to come out of hibernation, right? I often say this, my partner and I'll do this. Okay, so say you've been asleep, you've been in a coma for 10 years or 20 years, and you come out and you don't know where you are, you don't know what's been going on in the world, and you say, give me the stats. Okay, and you go, well, price to earnings ratio of Shiller PE on the S&P is 26, Treasury yields at 247, 5 years into a cyclical bull, 160% recovery in things like the S&P over this period. You've had, zero interest rates. You've got like all of these things. Dividend yields are less than 3. All of that. you would say to yourself, wow, I would go hard defensive. I would move it liquid and safe as I possibly can. And if I'm wrong for a while, that's part of the deal. Like, it's impossible. What I think happens is people come up with a thoughtful, like they go away, they do a bunch of work, they do a bunch of measurement, and they come back and they say, well, I've taken the measurements and the probabilities of losses are 85%, and in some cases 50% losses, and the probabilities of further gains are maybe 10 to 15%, and then you'll have probably 50% losses. But if that doesn't happen in the week or two after the person comes out with that thesis, everyone that thinks very little runs around going, you see, they're wrong, we're missing, they're wrong. No, in my business, being wrong means you lose a chunk of capital. In my business, I have to accept that I may be early and I have to look wrong for a while before I can be shown to have been wise in the judgment call. So, Talib said, because of that, accepting the things you can change, and then the wisdom to know the difference essentially is to say, I can only take these measurements and assess the probabilities. I can't know exactly which piece of sand is going to be the final one that, crumbles this whole castle, but I'm prepared to wait and prepare myself for that inevitable outcome so that I'm able to step in when others are panicking, so that I have a plan of attack in advance, and so that I'm able to navigate myself through this whole secular period intact, not just for a year or two or three of it, but for the full secular period, which is what matters the most.
Yeah. And that's really the key, is to have a plan, because I don't really think these guys out there now have a plan at all. It's just buy, and that's it.
Well, and an article I put on, I think it was last week on the blog, was a CNBC survey who said that most money managers they'd surveyed were recommending an increased exposure to equities to clients today, an increased exposure, and that their plan, or their 75% of them said that they believed clients would maintain these positions through the next downturn, which of course is fantasy. It never has happened. So those are the same guys that were very bearish of equities in 2009 and were looking to change jobs. And now they're uber confident in recommending people actually increase their equity exposure today. So you have to really think outside of that consensus box in order to be any use at this work at all.
Yeah, some things never change, Danielle. And hey, we go over to Elizabeth Warren. Now, not my cup of tea. I think she's a hypocrite, and, she's trying to be the common man, the common person, but, she's a extremely wealthy person in her own right, taught classes at Harvard, one class a week, got paid $350,000 a year. She's not the common person. And, there was a whole scandal when she was running for Senate. She claimed she was part Cherokee Indian. And she was even listed on the Harvard faculty as a minority. And then when those claims were examined closer, found out that she wasn't at all Indian, and she picked up the nickname, the moniker Pocahontas. But putting all that aside, okay, she's the only one standing up to Wall Street saying, basically, you guys are a bunch of criminals. You're stealing from everyone, and it has to stop, and is lobbying heavily for a return to Glass-Steagall. And the other thing is, love her or hate her, she does seem to actually understand what is going on in Wall Street, which, and I know very few of those people of extremely limited talent and intelligence up in Capitol Hill have a clue what's going on Wall Street, Well,
first of all, I don't know Elizabeth Warren personally, and I don't expect anyone in public office or otherwise, frankly, to be perfect or without potential weak spots or criticism. And I think, Kerry, if you were in the job, people would find stuff probably.
Oh, that's why I won't go there. Don't worry about it.
And me too. I mean, I don't know. They would probably pull out something that they would suggest is hypocritical. But let's be careful. You don't have to be flat broke to be of value, in my view. I mean, you don't have to
pretend to be something that you're not. That's all.
Okay, so let's just leave aside that little segue and talk about the value of what she brings in a very rarefied room of leadership when it comes to reforming the banking sector. Yeah. And I think that she has been an important leader in that regard. And yes, you can say that you think the Consumer Protection Agency is a farce and you don't like more regulation. I think that the discussions that she prompts are the right ones. Perhaps you can argue about the execution and the best way to do that. The reason that Dodd-Frank was 2,000 pages, though, is because they wouldn't just do the very simple and necessary step of dividing investment banking from the deposit-taking institutions. And so that's why when she and Senator McCain proposed, the bill to reinstate Glass-Steagall, that has some consistency about it. I believe that is obviously what needs to happen. And it's painful that we've gone on for this many years since the financial crisis, 4 years into Dodd-Frank, and they're still talking about, that isn't going to solve the problem. Well, of course it's not, because they gutted it of the main thing that it needed, which was this critical division between these two parts, the risk-taking and the deposit-taking. And, you've got the cult of Jamie Dimon still alive and well, and all the usual suspects getting paid for scale rather than for any kind of wise management. All the stakeholders have voted for short-termism, for increasing leverage, for increasing risk taking, for marking compensation of executives to earnings growth rather than to the balance sheet or quality or long-term planning. So all the incentives are in the wrong place. And I think that Elizabeth Warren is one of the few people who cuts through the baloney and says, did you see her cross-examining Chairman Yellen? Yeah. In her Senate testimony, I think that was last week or the week before, when she was calling her bull on the Fed sitting there saying that they've been working with the major banks, and for example, J.P. Morgan, who's put forth this proposal for how it should structure its capital structure, and Yellen's like saying, oh yes, well we've been working with them for 4 years, and Elizabeth Warren said, wait a minute. Every single year they've put forward a proposal and you've said not good enough, go back and work on it, not good enough, not sufficient. And you have done zero to call them or force them. And may I remind you, Chairman Yellen, that in fact, you guys are mandated by law. It's not a question of we don't have the rule set or the mandate. You've been given the mandate to actually literally yank their ability to operate or to divide them up and do what is necessary to restructure banks that don't meet with the safety and security aspects, which are required in our system. And so she just called bull on her, and there was no response. She looked like she had no answer, and that's because she didn't. Because the Fed is a toothless entity set up by the banks to protect the banks and to get them free access to public money. They do that brilliantly well, but to pretend that they have any other mandate is our error, our mistake, and our fallacy in the general community.
I couldn't have said it better myself, Danielle. Let's face it, that's why they were set up. After the panic of 1907, they were specifically set up as the lender of last resort. That's what they're there for. So let's not kid ourselves about their purpose. And, now they've become the Uber planner, the Uber central planner, and they're going to make everything right and get the economy functioning when the Congress refuses to basically do its part. They won't even pass a budget, the Congress, anymore. And, so you can't really expect them, the Fed, there's a limit to what they could do. But I like her because I hate the expression speaking truth to power, but that's effectively what she does. She just has a basic failure or lack of ability to comprehend basic economics, which is that, free markets, when allowed to flourish, will best serve mankind's needs. And, that we all need to work towards free markets to really benefit the largest number of people. But, until we do that, I don't believe anything is going to work. But, I believe that when she does speak and exposes, the hypocrisy of a Yellen, and when she nails these bankers up there when they're testifying and catches them in out and out lies, she's doing a service. So, whether it's in, they're trying to get her to run for president now, that's a little extreme. I don't think she's got the abilities, the skill, or the temperament. She really can't go off teleprompter, but for another day. So, Danielle, we got to conclude now, but go over to jugglingdynamite.com, sign up for Danielle's newsletter, and go over to financialsurvivalnetwork.com, sign up for ours. We will talk to you in a couple of weeks, Danielle.
All right, Kerry, take care.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.